Hi, I'm Mark from Gostocks. We have designed a market tracker which broadly gives an indication as to how the market is performing with respect to the previous week. It's a weekly tracker which we have been sharing with the customers for the last 3-4 months. So it covers about how the sectoral behavior has been for the last 1 week with respect to the Nifty, as well as it covers about the commodity. It also covers about the broad indices. We also give an valuation index, which broadly gives an indication as to how the markets may perform in the coming week. So the valuation index has been designed in such a way that it covers 3 critical parameters. One is market cap to GDP. Second is forward PE for financial year 23. And the third one is the earnings yield. So these 3 parameters has given an equal weightage, and then we give an indication value as to whether the market is in an overbought zone, or the market is in a fair value, or the market is in an oversold zone. So this week the valuation index is giving an indication as to sell, and the same was the indication for the last week as well. And we saw Nifty correcting in last week from 18,800 to 18,500 levels. Now, we also thought it is appropriate for us to give an insight on the 3 critical parameters. So, market cap to GDP. This is something which was famously designed by Mr. Warren Buffett to understand where the market is with respect to the growth that the economy is having. So, today India's market cap to GDP, or Nifty's market cap GDP, is at around 111%. The fair value for market cap to GDP is at around 80%. So we can conveniently call it as overbought zone. And the second one, forward PE with respect to FY23, we take into account the Nifty earnings for FY23, which means the Nifty EPS, which we projected to be at around 810. And with Nifty at 18,500, it translates into 22 times premium, which is again an expensive zone. So the fair value for forward PE will be at around 16 to 17 times Nifty EPS. The third one is the earnings yield. This is designed in such a way that you compare the earnings of 10-year Government of India bond with the earnings of Nifty. 10-year Government of India bond today is trading at around 7.3%, which means if somebody can lock their money for 10 years, they can get 7.3% seamlessly with a government guarantee, which is the best thing that can happen. Vis-a-vis, if you look at Nifty earnings yield at 22 times P, it translates into 4.2 or 4.3%. So which is again not so attractive when compared to 10-year bonds. So that there again, it indicates that Nifty is in an overbought zone. So combined valuation index gives a sell signal based on these 3 parameters. So it's a broad indicator for the near term. It can keep changing on a weekly basis based on how the market capitalization of the Nifty is going to behave, as well as how the 10-year of Government of India bond is going to behave. We keep tracking this on a weekly basis and give you the insight. You can use the market tracker rather on a weekly basis to understand how your portfolio is also performing. Thank you.